Well, they're getting ready. I only have a brief time here, so I'm going to just start in. We're going to be talking about opportunities for big data, and this is actually going to be a very short version in 20 minutes to have this topic of a much longer presentation that I gave at the first big data conference in Berkeley about a month ago. Which, in fact, if you like, I can send you the entire version, and there's a video of it I can also send you a link to. But what we're going to have to sacrifice out of that presentation is really a lot of context, okay? Because the way I really wanted to do it was to put it in a historical context of where big data fits in. And there's been a lot of hype, and whatever. And while there is hype, having actually thought about this a lot, and even thinking about it as I listen to some of the speakers today, I keep getting new ideas as to where this can be applied. Some of them probably surprising to you, and in fact, really not the approach that people have taken. But I think there are some very valuable contributions that big data can make, certainly in my aspect of financial modeling. My aspect, really, I'm a credit strategist, and I try to predict what the probability of people defaulting is, what the current price of risk is what people charge for using volatility and so forth, and even more general things like predicting, non-farm payrolls and things. We'll get into that. What I'm going to use as a context is really my specialty, which is predicting default, and show you how, and probably the only application that I know of in finance that's out there of big data is actually to predict default. So that's what makes it relevant, and then I'll talk about where things can go from that. I think there are some equity applications as well, but I'm in fixed income, so it's the only one I can find that I've around a lot. So, and nobody corrected me at the conference, so I think I'm pretty much right. I'm going to skip through a lot of these slides. Even though it's a short version, it's going to be a lot shorter even than what I have here. But like I said, I'm going to talk about credit models, a little bit about predicting default, how big data models have been applied to predicting default. I'm going to say a little bit about what big data is and what it isn't as well. And then we'll talk about more generally about where I think it can be most effective in financial modeling. So, right, and I'm going to skip a lot of this, right? We sort of get into financial modeling. Really, there are two types that I see of financial modeling. There's the accounting and corporate finance applications and quantitative finance applications. And in general, I'm going to be talking about the latter. And again, these slides, I don't know if the conference is going to make them available, but I can give you this just to give you some background as to what they include. The quantitative finance models, which I'm going to talk about, are sort of option pricing derivatives, credit risk, the kinds of things that people have been talking about here all day. And so what is big data, right? Basically, when people talk about big data, they're really talking about four things, right? And volume, like large amounts of data; velocity, right? Data coming in very rapidly; variety, right? Coming in from a large amount of sources, like balance sheet information, market prices, so forth. Things over the wire, so forth. And veracity, data integrity, and that is, how can you determine whether the data is actually correct or not, which is one of the other challenges. But basically, big data uses inductive statistics and sort of nonlinear models and so forth, and reveal relationships. And I guess I defined it a little bit more here. I'm not going to get into it too much. Again, just in the interest of time, I'll try to have you, out of here in my time allotted, and maybe give you time for a question or two. Again, I'm not going to, we're going to sacrifice a lot of the background, but talk about credit risk, which is the application I'm going to talk about. And basically, the main risk with credit, at least that people think, is default risk, which is the probability that if you lend somebody, you're not going to get paid back. And then the other part is recovery value with default. We're going to talk a little bit about that, meaning if I don't get paid back, I have a claim on the assets of the firm. What do I expect to get in recovery? And of course, I keep turning this thing off. And so, I just define default here. You can just think of it as somebody fails to make a coupon or principal payment. And default rates, right? Here's a historical level of high-yield default rates since 1920, and you can see they go up and down cyclically and so forth. Now we're actually going to be talking about predicting defaults for individual firms. I'll also say and this is because one of the applications, primarily exists. Yeah, that I'm going to talk about that has been under-modeled is recovery value in default, and expected losses are not only dependent on the probability of default, but they're also dependent on what you can get in recovery value. And while people have spent enormous energy on modeling defaults, they've spent a lot less energy, and there's a lot less data available to help us model recovery value, and which is just as important as defaults. And that's one area where some of the other things that are not so readily available, like who's in front of you to get paid and so forth, that might be in various company reports and whatever, can be very useful for our big data techniques can be useful for recovering that, right? And so there are many things that recovery depends on. I've just listed a bunch of them, but it's basically where we are in the credit cycle, the seniority of the debt, the industry sector, the credit quality of the obligor before the default. All these things are important. Now, really, just for a general perspective, where does big data fit? What we can see, and by the way, in this talk, and and I'm not going to spend time here on it, but in the bigger talk, I've really gone through the sort of historical progression of models, and each sort of is basically before 1900, right? Fundamental analysis was it. That was you get an opinion from a your favorite investment banker and whatever. And in 1909, John Moody basically developed the rating scale. That was, I guess, our first and probably most important model. And then we went through statistical models in the 60s with Altman's Z-score. I would say it's the first real modern model, and through Merton models, risk-neutral default models, we get some expert systems and neural networks, and to big data models. And the real, now, very interesting, by the way, is that that all of these model progressions, and they, and as we go along, they vary in complexity. The necessity for computing power, the theoretical sort of elaboration continues to increase all the way down. But all of these models are still in use in one form or another. But it just becomes, what I see is that they predict, sort of defaults and other things on shorter recovery times and with sort of greater degrees of accuracy. But anyway, our first thing is the rating scale. Again, I'm not going to really talk about this because we're going to get, I guess I'll say one thing, right? The reason we need credit models is because credit ratings typically lag the market perception of risk. Actually, not only the market perception, but literally firms' risk, right? Credit ratings and they don't really put a probability of default on things. They just give it a numerical rating an ordinal rating, and the probability of default varies over the credit cycle. So while useful for many purposes, certainly not for modern trading environment or credit portfolio management. And I don't want to make it wrong here. Okay, and then just a nod to Altman, who basically I would say be the father of modern credit modeling, who developed this Z-score model, still in use by some people, and still useful for certain purposes depending on the degree of accuracy you need. And why am I still having this? And then there are more complicated models. One of the things, I hesitate to show this. Let's not bother with this for the moment, in the interest of time. I'm just really, this part of the talk is just going through models. I want to get to the big data thing. So these are really, I'll just say this, right? That probably some of our best models right now are, at least in terms of predicting physical probability of default, come from the Merton theory, where basically we look at the equity holders as having a call on the asset values of the firm struck at the level of the debt, and so forth. And because literally, at least in my applications, I find these very useful because idiosyncratic risk in the equity market tends to give me an edge in the bond market, and sort of how I make my living. These are probably some of the best models we have for commercial industrial firms. Unfortunately, these models are very poorly on financials, and they can't really score anything that doesn't have tradable equity, which means sovereign debt, municipalities, non-public firms. And so we always look for more models. And in fact, that's one area where I can see big data helping, because we don't have very good models for any of the latter things I mentioned. And one model that sort of performs a bridge between what I would call big data models and current models and big data models is a Euromoney country risk score, which is sort of interesting. They've got an expert system where basically 400 experts sort of fill out a scorecard on various sovereigns on political, economic, and structural dimensions. And actually is very useful. I mean, I use this for predicting sovereign defaults. It's a little bit complicated how I do it. And you'll see, and the reason I mention this is when we start talking about and going forward, one of the applications I see for big data are two of them are actually filling in this scorecard, not only for sovereigns, there are like only about 190 sovereigns that issue debt. And so you can actually get experts to fill out scorecards like this, but there are basically more than 30,000 firms that issue bonds all around the world. And if you could get a machine to fill out these scorecards on every bond every day, you can translate those into probabilities of default, that would be very useful. Model. Municipalities, same thing. So let me just, so let me talk about one thing. Let's go to big data now, right? In any case, now, and again, all this would have been, preamble to set up the last part of this talk, but I'll go through it. Right. The one financial application that I know of is the star mine model by Thomson Reuters, and I'm not, basically went to that. It's just that's the only one I can get a hold of, and the only one that I really know of. And this model does two things. They built a model to predict default, and they actually have a model for predicting sentiment, and as applied to all these actually economic indicators, of which for me I know the most important ones are non-farm payrolls and ISM manufacturing. And why I say important is because the volatility in the markets, our markets are most volatile when there are surprises in these numbers, right? So what StarMine does, and I'm going to show you how they do it, which is give you a little background on some of these models, but basically they try to beat, if you will, the experts, right? Basically there's a consensus forecast on these things made up of views from economists around the around the street, around the world, and basically StarMine, right? This is a very simple application, almost not big data, but what they've really done is they've taken these estimates from these economists and they say, I'm going to overweight the estimates from economists that have been right and underweight the estimates from economists that have been wrong. Okay, I think it's a little bit underused, and we'll talk about that in a minute about it. But in fact, what they find, okay, first of all, is that this is the start of the year accuracy quintile for they put economists in one of 5 buckets, right? The fifth bucket is the best analyst, and the first bucket is the worst, right? And what they look at is when you start in each bucket, what is the probability of transitioning to all the other buckets over the year? And what you find is that if you start out in the best bucket, okay, the likelihood of you staying in the best bucket by the end of the year is 40%. And if you start out in the worst bucket, right, the likelihood of staying in the worst bucket is also 42%. So basically there are consistencies in the economists who tend to estimate the non-farm payrolls. And since what they do is they basically build a system based on that, and and they basically show, and I'm just giving some of the statistics as to how they can outperform the index, or outperform the economists just based on that. I think that's a little bit of an underutilization of what they have. But let's go back and now I'm going to take you through really how this big data things work, at least as applied to credit modeling itself. And basically, and this is the Thomson Reuters StarMine model. And again, like I said, I'm not, I have no relation to StarMine except that they have a model, and it's the only one I know of, right? So what they do is, right, is they use, and the techniques are sort of the same of scrubbing documents and getting sentiment, but they combine brokerage research with transcripts of articles on companies filings and Reuters news, and they basically filter all these things, and that's really the trick in big data, is actually extracting meaningful information from documents and turn them into a signal and a probability of default and a risk score. And basically, they're, again, here, I just mentioned the same things that I had there, but they basically look on 4 dimensions. They take these 4 sources and they turn news from each of these 4 sources into 4 dimensions. So each source is giving information about income structure, firms' income structural, legal, and external factors, and they combine them to, give a letter grade of probability of default and a rank. And basically, right, so they're filtering words, right? They're looking at documents, right? And they're actually, taking words, and that's one of the tricks in these things. And they basically, try to figure out, like, earnings are up. In fact, I think I have an example of that in one of these slides. But yeah, well, this as I get there, this is just, it shows again what I said, that each of these sources gives information on income structural, legal, and external aspects of the firm, and they just sort of rank which sources are best for which type of information, which is another interesting thing. And yes, and here is how they break up their bag of words, right? So that income category focuses on language considering earnings, the net loss, right? Strong growth this quarter. These are the kind of things that would give a positive or negative signal as regards to credit quality. But anyway, and then they just calibrate their scores against probability of default. Now, and what they show is that basically they can beat the Altman Z-score model. And this is what this is a slide I didn't show you as to how these things are computed. But the point is that if I rank, population of obligors with respect to my risk score, since default is inherently a probabilistic event, right? I can't say with certainty that somebody's going to default until the day they don't pay, right? So I'm always making a probabilistic statement. What happens is that that their StarMine model actually beats Altman Z-score. So if they go through the top 10% of what the model thinks are riskiest firms, Altman's model catches 40% of the risky firms. If it just was operating at chance, it would catch 10%. So it's Altman model's doing something, but this model's doing better. As an experienced observer of these kinds of curves, I would say this is about what your better credit models get on this dimension. So really, all this machinery, as far as default prediction goes, isn't adding anything. And this is why I'm going to show you why I think we can do better with this. So anyway, features, right? Let's talk about limitations, right? Because I think it's more. The model isn't any better really than what we have now, and and you have to develop a front end to extract the information. But where do I see its benefit? Let's talk about that, right? Because literally, the more I think about it, the more I see its benefit. But it isn't in what computer scientists heretofore have perceived as its benefit. For example, what I really think is that I think these techniques could be extremely useful for forecasting the inputs to my models, right? I'm looking at at earnings and and leverage and other things, right? What if these models tell me about about the parameters that I have to estimate? I can't read all these documents and whatever, and give me forward-looking information not only on what people have reported, but on what their debt's going to be. What if and in terms of recovery model and default, do I talk about that? I guess I don't. Just telling me, for example, who's in line ahead of me in default will tell me a lot about what I can expect to receive in default, which is important. It is important in the market. It's important to how things trade. And so pick. And by the way, I'll say this because I use these credit models, right, to trade credits long and short, and tell customers which credits are paying them, a greater than average premium for their default risk, recovery value, and duration. And the better model I have, the more I can, help my customers and my firm manage their portfolios. And if you told me, right, Terry, I took your model and I used these big data systems and I've gotten the inputs and I've improved your model's performance by 5 or 10%, to me, I would almost have to buy that model, right? There's nothing about the StarMine model that makes me compelled to want to buy it because it performs about as well as mine, right? If you tell me you've taken your model and beat my inputs, some of which are backward looking, like equity volatility and even debt levels and so forth, and profitability and other sorts of things, I would actually, and you actually showed me that you outperformed, I would buy that, right? Also, I already mentioned this as inputs to a scorecard system for corporates, right? I mean, the rating agencies actually use a scorecard like this to produce their ratings. And, and I've turned these ratings into probabilities of default using this particular expert system. If you filled out this scorecard daily from all the things coming in and all these reports and whatever, and generated probably default for corporates, I can't imagine it wouldn't be as good as our best models. And then actually, you know, you can actually take, you know, the scorecard, the structural model, and statistical models of default, put them all together, and you could actually build a sort of a super model for default risk, and that's this one. And so let's see, yeah. So here are a list of opportunities as I see them, and this I'll wrap it up and maybe have time for a question or two. I think I brought it in pretty much on time, as I promised. Models of recovery value and default, critical. We know so much more about probabilities of default than we do about recovery value models, or recovery value. Enhanced sentiment models, right? Rather than you know, just take the economists that have been predicting, right? Why don't you build an economist based on, you know, on what an economist would look at in terms of sentiment? Again, if you can predict non-farm payrolls, you know, better than the consensus, you can make a lot of money in this market. Probability default model for, right? They concentrated on corporates, right? Why not concentrate on municipalities, private firms, sovereigns, the things that we don't have very good models for? Models of bond relative value talk about which bonds are trading rich or cheap, which bonds are going to increase in price, decrease in price, opening and closing prices across markets, forward-looking estimates of firm financials. This is going to be useful even as a fundamental analyst, as a, you know, corporate credit analyst that's sitting there, right? You use, you know, can you beat the best analysts, you know, because they're looking at the same things that the model would be, except the model is tireless and sees everything all over the world, sees even other analysts' opinion and so forth. So, in analyzing bond liquidity, by the way, there is a, I will say this, that there has been work done by Bloomberg in their B-Val system in analyzing bond liquidity, which really borders on, I would say, would be a big data application, because they're looking at literally the 30,000 bonds that trade every day, extracting information about what would be the movement in price if you had to trade these bonds and liquidate a position of a certain size. I think a very, very good application. In fact, I have recommended the guy who built it for the next data conference. I think he would be very useful. So, yeah, so enhanced economic models for economic releases again. And I think that's it. Well, let's just talk about, you know, the critiques. And by the way, when I looked at the critiques, and these critiques aren't mine, I searched the web, right, and looking at everything people say about big data and whatever. And, you know, black box. You know, it's no different than a lot of other models. I mean, every model has been, and well, the truth is you can build a black box model. One of the reasons that I say that they should try to improve the parameters on the models that we have is that a lot of the models that we have are rooted in financial theory and have a very sound sort of financial theory behind them. So if they can actually, you know, help us get better inputs into those models, that'll be good. Yes, there's no substitute for domain expertise, right? I mean, you have to know that, you know, you need somebody in finance to help you build a successful financial model. So far, I haven't seen a lot of that aside from Bloomberg. Backward looking, you know, meaning how do we know that, you know, what we learned from, you know, from data that we've looked in the past and tested will predict the future. I don't know that criticism or that isn't true for every model we use, right? How do we know that the past is going to tell us about the future, that there aren't emerging properties of things and whatever? Execution, right? Big data has been called a fad. I love that. Somebody called it pig data, and you know, and potential sampling biases, right? One example I found was that there was an election results they were looking on Twitter, and Twitter not being a representative sample of the actual participants in the election. I think it was for Academy Awards. Is that what it was for, right? And that, you know, you have to sample a population that's reasonable regarding the outcome, and integrating data across sources. I actually think when I see the computer science, I actually think the computer science behind this is there. It's really just not the applications. And let's see what else. Privacy concerns, of course, on the consumer side there, and even in our bank, there are privacy concerns, right? What data can you use? I mean, we already know from our credit cards, right, that, you know, our credit card data, our input to, like, you know, to the, you know, consumer spending and other things, right? So we really have an advanced, can we use that to make money and so forth? That's not, you know, that would be responsible. There are issues with that. Let's see, big data is failed to deliver. That's what some people say. Maybe so. I'm starting to see it deliver. I certainly think that the Bloomberg application is And when people talk about simultaneously testing a lot of different hypotheses, you're going to, at the conventional level of significance, actually get 5% of those false positive and so forth. Always, there's no substitute for intelligence anywhere, including model building, and there never has been. So I don't find any of these criticisms per se all that valid. So where are we at here? Closing thoughts. It hasn't been clear yet how best to use the data. Certainly to the implementations that have been done. All I'll say is that that again we're just starting to see the uses, and certainly I'm open to partnering with people in this field to make my models better, and I do see both us and I hear this in our firm, right? I mean, I can see where as a firm that has a lot of data as well, we're actually attuned to this and trying to see where we can best make use of it, which is in fact how I came into this problem in general. I've sort of been asked to take a little bit of a look at it, and but again, just like anything else, there's no substitute for intelligent model building, and with that, I'll just leave it. If I have time for a question, I don't know or not, but we'll do that.
Well, thank you. I enjoyed the talk, and it makes me think about the questions you're asking about what kind of problem do you apply this to. So my immediate question for you is, you've chosen a hard problem. Okay, in other words, defaults of bonds or loans. Defaults are, even in high yield cases, are pretty rare. So therefore, it's harder to test whether you're getting valid results. Why not choose an easier problem? Such as, and I know it sounds crazy, but that's part of the point. I'm gonna build a model that tells me the probability function for where Facebook stock is going to be in 12 months, or IBM stock. That way, you get much more immediate feedback on how accurate this is. And I think my reason I asked the question is, if you tell somebody you're going to build that model, people won't believe you that it'll work. But you'll be able to show them very quickly yes or no. And whereas if you build a model about default risk of Toys R Us and other high yield issuers, it's harder to end up agreeing it worked or it didn't.
Let me say two things, right? About you raised a lot of issues. As one, first of all, right, where default, every firm has a default probability, right? You're not just estimating, when you estimate default, right? I mean, but I have like 5,000 defaults, right? And that isn't enough defaults to get an idea of whether a model. First of all, the default per se, but default per se is only one end of the spectrum. I want to know what the likelihood that this firm is more risky than the next firm, and then I want to know with that likelihood what the duration of their bonds are, what the recovery value in default is, and where their credit spreads are trading. Okay, so default risk is one of the main. I know I'm going to lose a certain amount of the cash flows that I promised, right, due to my expected default rate, right? So, right, what I want to do is figure out where the market is sort of underestimating or overestimating the default risk of this company as the implication for its credit spread. And so it'd be very important to me, okay? It may be a hard problem, but it's important. I don't know if when you talk about equity 9 to 12 months later, I believe that's a much harder problem, because it isn't just the performance of the firm that the equity price is determined by. It's actually the performance of the economy in general. So you can say, Pfizer stock is going to go up 10%, but the whole market may go down 40%. I mean, so that's not going to tell you whether I would say, right, if I had to do this, I would want to know where the market is going to be 9 to 12 months ahead of time, and that's a very good problem. But I think that's a tough problem. Okay. I mean, believe me, I try to model it. I try to model equity prices and whatever. I would be settled for, I don't even need a year, right? But you talk to a trader, they don't want to tie money up for a year anyway, right? I mean, maybe your average person does, but tell me where it is tomorrow. I think that's a better problem. Just tell me where the market's going to close today, and I'll put all my chips there today, and then tell me tomorrow. And rather than get one chance a year, right, I'll get 365 chances a year to realize the probability edge that I have. I mean, is there, yes?
Yeah, I think your talk was really incredibly fascinating. I'm wondering, in the context of the gentleman's question about probability of default and so on, how critical that is when you look at implied credit spreads on bonds. That's just sort of without which nothing. And it seems to me that with the bonds, you're sort of insulating yourself not only from equity markets, but from large interest rate moves over relatively short periods of time, because you're looking at relative credit spreads. So there's a question in here, and the question is, has it shown any success as a bond trading tool to make money in the bond markets?
Yes, that's how I make my living. I would not have a job if that were not true. Seriously.
No, it's fascinating.
And I've had a job at the same firm while it's changed around me for 20 years now, so.
So it's proved itself.
Correct. Yes.
How would you deal with something as complex as, say, TXU?
The firm, now you're talking energy firm? In what sense? In terms of its probability of default?
It has hundreds of new entities and, intercredit agreements and all sorts of structure.
Okay, because, right, there are two ways, okay? Now, its financials are complicated, right? But let's just, I simplify the financials to one thing, and then I add something else, okay? So, first of all, I look at its leverage, right? Okay, how levered is that firm, right? What are the assets relative to its liabilities? And one of the things that I get is that the equity market tells me, okay, first of all, right, where the assets are today, which are basically the price of the stock times where the assets are the debt level, okay, that the firm has, and the assets are what the equity holders are willing to spend for the stock, okay? So it's in the debt level plus the equity price times the number of shares outstanding. Okay, that tells me that, right? I look at the equity volatility, and that tells me, but the equity volatility tells me how uncertain the market is about that, and then I let that equity volatility go out, and I look at, you're asking me, right? And I look at the states of the world given that equity volatility in which, and this would have been part of my previous talk, these are the sort of the stated markets in which the firm is insolvent, that is based on the volatility of the equity. And if I could get forward-looking volatility, much better, right? This is where big data could help me, right? I would, say this is what the market is thinking the probability of this firm going into default is, and then I'm a little bit careful about sectors, right? So I would go into the oil and gas sector, right, and I would compare. I might say that maybe that absolute number that I'm putting on TXU is wrong. I certainly believe that in financials it's wrong because of the leverage situation relative to a corporate firm that basically has assets, takes a while to default. A financial firm, if it can't borrow money, defaults right away. I would look to its peers, right, and then I would say, on these dimensions, right, is it more or less risky than its peers? And its peers are giving me this much spread for this probability of default from my model that I just described to you, and its duration, and what I think I can recover in default. And then that's how I determine whether I think that credit is trading cheap or fair.
So these are historical default probabilities. That's what you're saying. This is not tradable information based on risk neutral default probabilities.
No, they're not. In fact, yes, because that just, I think, it always puzzles me. Risk neutral default probabilities are just a logarithmic transformation of credit spreads, and multiplied by the recovery value. And for most firms, the physical probability of default, the spread compensation for default for an investment grade firm is almost nothing. And so why are we multiplying this non-default spread by recovery value? I'm actually, as somebody in credit for 25 years, I'm really puzzled by that. On the other hand, it's like when I say that, it's biting the hand that feeds me, because if it weren't for that, we'd have no credit default swap market.
Because we can trade that information. This, of course, is historical predictive.
Well, you can't trade it because it's just a restatement of credit spreads. What that other piece is, people call the credit spread puzzle. What it is every day, by the way, and I know this because I measured, it's really the price of fear and greed. If you strip off the spread compensation for expected default, the ratio of the spread to volatility across from AAA to triple C to a very good first approximation is the same ratio, and that ratio goes up and down with the price of risk, and that's your main risk in the credit market. And people always think it's default. Default risk changes very slowly. It right goes up and down, right? And you can protect yourself from that. You can't tell where that risk premium will be. Defaults start to go up. People get scared. Right, they charge a lot for taking on volatility. Right now, and I measure this every day, I measure the price of fear and greed every day. Right now, people are taking right? The least spread per unit of volatility, the fifth percentile that they've ever taken, okay, and volatility is about the fifth percentile. So people are taking 3.2 basis points per unit of spread volatility. The average is 4.8, and they've been taking it since the Fed's had, QE on. For the longest, it's ever been below average, and volatility is so low. I think it's like a loaded spring. But this is the kind of conversations I have with clients, right? This is really, I go to firms and I talk to them and they say, what should I do, with the market? Where do you think it's going? I mean, these are the kinds of things that having these tools allows me to do. I hate that.